With the recent sell-off in resource companies, many investors have been wondering whether this presents a good time to begin increasing their exposure to the sector. In the view of one investment manager, the cost increases being seen in the platinum sector will ultimately be passed on to the consumer. Joining us in studio, Nick Norman-Smith from Lentis Asset Management. The big question, have you started buying resources, and which ones, and should we follow suit?
We've been buying selected resources for a while now. We've liked Sasol for a number of years. We started buying to the platinums towards the end of last year and have been buying down into the weakness, so clearly a little bit early there. But we've been a bit wary of the diversifieds and the copper and iron ore producers, being pretty hammered on this show by actually being one of the few non-China bulls. But we just thought that the fundamentals behind a lot of these businesses were expecting too high commodity prices, and that was causing unrealistic valuations. We're now starting to see some of them come down. So a company like Anglo American is finally starting to look
You got
interesting.
it. You are buying Anglo American. Let's just have it on the record.
We are indeed.
He's buying Anglo American. This could be the red flag we've all been waiting for.
This is it, Nick. Just in terms of the way when we corresponded before the show, I asked you if you held the commodities directly in the form of ETNs or ETFs or whatever the story is. To me, a mining company is the difference in margin between costs and the commodity price. With Amplats, with Lonmin, we've seen dramatic increases in the cost side. Why are you buying Amplats at such a time when the costs are rising and there's been very little fill-up in the commodity price?
The key, and it's a great question, is that with a commodity like platinum, South Africa is the dominant producer. We're pretty much the monopoly producer. So if the costs of pulling platinum out the ground go up, there has to be a commensurate rise in the price. If there's not, supply will get shut down and basic economics will eventually move the price back into equilibrium. That's why platinum versus a lot of the other commodities is still something that we're pretty bullish on, because if you look at a commodity like iron ore or many of the others that we produce, if the costs in South Africa go up, people are just going to buy it elsewhere for cheaper, and our mines are going to be unproductive and they're going to shut down their supply. So it's all about the constraint that we have in terms of where the platinum supply is available.
So by saying that, though, you're implying that it could actually get worse, because in order for that the price, the cost inflation to transfer to the commodity price, you've got to wait for supply to get cut first. And that could be obviously a very painful process for many platinum producers. So is there a particular angle why you chose Amplats there? Is it because of the parent in Anglo American that'll ensure that it's still around in 2 years' time?
Mainly we wanted a solid business because, as you say, it could be a while before things turn around, and we want that business to be there. So the marginal players with weak balance sheets, I'd rather steer clear of. If the cycle turns earlier than you think, you'll probably make a little bit more money, but there's obviously significant downside risk. Amplats has probably been the poorer cousin of the two in terms of how well it's done over time. Amplats has often been the favored one in terms of better margins. So that, we believe, has been more than incorporated in the price. So from a pricing perspective, we like Amplats, we like their dominant position. But at current levels, there's not too much between someone like an Amplats and an Amplats.
Here's a bit of a curveball question. If you like the majors, why not go for the real kicker? If you believe in the platinum story and that we will receive a recovery in the platinum price, and go for the smaller companies in that sphere that will have a bigger upward trajectory when it does turn.
Yeah, the key with that is downside risk. So as investors, what we like to do is protect the downside first, because that's where you really get hammered. Because as we know, a 50% decrease in a share price means you have to go up 100% to get back. So it's actually not about finding the one great investment. It's about finding the basket of decent ones and avoiding the really terrible one. So by taking on the high risk of investing one of the marginal miners, it could come off, but you could lose quite dearly.
Just in terms of your selection of Anglo American, one of the things that we always ask investors that come onto the show, we say, well, what's your view on commodity prices, and what are the price earnings multiples saying about commodity prices going forward? You guys use a slightly different approach. Why don't you just, for the benefit, tell us how you come to the valuation of making Anglo American cheap at this point, or worth buying?
Sure. So what we do is we look very simply at the marginal cost of extraction. So how much does it cost to get the next most expensive barrel of oil ton of iron ore, etc., out of the ground. Because the thesis behind that is, if the commodity price is trading above that marginal cost, more supply will come onto the market, because why wouldn't it? People want to make money. If the price is below, supply is going to come off, like we're seeing with platinum. So the marginal cost provides a nice peg in the ground and a nice base. What it does mean is you're not going to buy Anglos and Billiton when iron ore is trading at $180 a ton and the marginal cost is below 100, because people are saying, but because of all the Chinese demand, the marginal cost is going to go up as people mine the cheaper ores. But what it does mean is you'll prevent yourself from buying Anglos at 500 Rand like people did a couple of years ago.
So what you're saying by almost by inference there is that Anglo American's got very low cost of production for many of the commodities that it's involved in. Is that right?
Yeah, certainly compared to the marginal cost. So there are cheaper cost producers across most of the lines. But what we do is we say, right, let's assume a through the cycle profit margin, a commodity price across all of the assets. And if we do that, we come to earnings which are significantly lower than Anglo's has been earning in a number of the really good years. But having said that, if we look where Anglo's is priced at the moment, it's priced at book value. So all that Anglo's has to do is earn a reasonable rate of return. And if you're buying it at book value, you've got a lot of the downside priced in. So we expect Anglo's earnings, especially in copper and iron ore, to come under significant pressure. We still think there's some downside risk.
Are you not concerned about management? It's something that I discussed extensively yesterday on Hot Stocks, that perhaps Cynthia Carroll's time is up. She's been 5 years in the hot seat, and a number of investors are starting to blame her for not delivering value. Is it unfair?
I think it is a bit unfair. Look, clearly the main thing that Cynthia Carroll's been hammered on is the Minas Rio project and the delays. And that's a $5+ billion project, which everyone's looking at and is obviously the focus. But she came in at a really tough time as the commodity bubble was bursting. And we forget very quickly, let's look at someone like Marius Kloppers. They went and bought a whole lot of shale gas assets, and they wrote off, $2-3 billion. I mean, that's half the price of the Minas Rio project in the space of 6 months to a year.
So you
resource
saying,
CEOs generally,
compared to Marius Kloppers, give Cynthia Carroll a break. Look how bad he is.
Yeah, I'm not saying that she's the most amazing manager, but she's cleaned up the assets. She sold off a lot of the non-core assets. Quite frankly, resource managements in general haven't covered themselves in glory. So we certainly don't buy a resource company for the management team. We buy them for the assets and the price that those assets are trading at. And if management manages to do quite well, great. At least we know that a lot of negativity about Cynthia Carroll is probably in the price, given the bad press she's got.
Nick, just turning our eyes overseas and towards some of the companies that you've been buying there, we've noted you indicated that you've been buying Berkshire Hathaway, Wells Fargo and Goldman Sachs. I think everyone knows who Berkshire Hathaway and Goldman Sachs is, but perhaps you could tell us a little bit more about Wells Fargo and specifically Goldman Sachs as well, because they're financial services companies, but very operating in very different spheres. What do you see in those two companies?
Yeah, so Goldman Sachs, you're right, very, very different businesses. So Goldman Sachs, we all know, it's an investment bank. It's definitely a high risk opportunity. It's one of the premier investment banks, which has taken significant negative press for a lot of bad things that it's done. It's been hammered rightly so. But it's trading below book value. And we think there are a bunch of smart people who, yes, there's going to be a lot of regulation in the financial services sector, but they've proved in the past that they'll get around those regulations and make money for shareholders. We don't think it's going to be different this time.
My problem, Nick, is that they are incredibly smart people. They're smarter than most of us. The only problem is, do not all the profits that they make go to themselves in the form of salaries and bonuses, and the shareholders just kind of dragged along at the back there for the ride? Or do you believe that those profits will be passed to
They will,
the investor?
They will, and I mean they've been under pressure from a lot of the community. They're significant shareholders, some of the management members as well. So yeah, look, that is a fair criticism. But having said that, they're the people who make the money, so you need to pay your raw materials accordingly. Otherwise, unfortunately, the talent's going to go elsewhere.
We've got one last question because we're also running out of time. But traditionally, value managers should stay away from resource companies by virtue of the fact that the main dictator of a resource company's share price, or the main elements behind it, are external elements such as the price of the commodity and often the exchange rate. beyond your control. But
And
there comes a time when these resources are so cheap that you just got to buy them.
exactly, they're not the greatest businesses, because if you look at it, every barrel of oil that you sell, you've got to spend a lot of money to replace that barrel. If you're Microsoft and you make software, yes, there's a lot of R&D expense, but making another version of Windows doesn't your marginal cost is not particularly high. So yes, they're not the highest quality businesses, which is
So
why we
traditionally
generally
you would stay away from
traditionally
them.
would stay away. But at a point in time, price tells you the story, and so we certainly we keep our exposure limited until the price is really, really cheap, and we'll only really significantly add to Anglos, for example, if pricing dictates it. But at current levels, as I say, at book value, you really are factoring in a relatively negative future.